Hello friends, I hope all you are fine. You all are fine. Now we are going to do few MCQ of section B of part 2 of USACMA. In this section B, corporate finance, we are going to discuss the topic risk and return and types of return. So let's see few questions of this risk and type of risk topic. First question is systematic risk. Systematic risk is the risk of individual securities measured by. The question is asking the systematic risk of individual securities measured by what? Top MCQs are options are securities contribution to the portfolio of the risk, security contribution to the portfolio of the risk. Second is standard deviation of the securities rate of return, and standard deviation of the securities rate of return with other similar security, and covariance between the security return and the general market. So first is saying the contribution to the portfolio risk. Second is saying standard deviation of the security rate of return, the standard deviation of rate of return of security. Third is standard deviation of return with other security. And fourth is covariance. You can see the word covariance. Covariance covariance of the between the security. First is security and the second is market. So you can see that the correct answer is this. Okay, D, because covariance is the relationship, strength of relationship between two things. Okay, and if we are discussing about the systematic risk, then systematic risk is the measure of covariance of return of security and market portfolio market. Okay, so that CV ranges between -1 to +1, and there is a 0. Okay, so if the market is rising and the securities, the rate of return is also rising, that means there is a positive correlation that can be greater than 0. And if the market, when the market is falling but the rate of but the return of security rising, then there is an inverse relationship that will be then the CV will be the coefficient of variance will be between -1 to 0. Okay, this is the concept. Okay, so the systematic risk of an individual security is measured by the covariance between the security return and the general market. General market is one thing and the security return. So this D is correct. Okay, now let's move toward the second question. The risk of loss because of fluctuation in the value of the foreign currency is called. The risk, what type of risk it is called, which is related to fluctuation of foreign currency. The MCQs are exchange rate risk, diversified risk, exportation risk, multinational beta. Okay, so we can see that here exchange, because if there is a fluctuation in the foreign currency, then that is called exchange related risk. Okay, exchange related risk is there. There may be that price of the domestic currency will fall, but there will be rise in the foreign currency. So that exchange risk. The correct answer is exchange risk. This is correct. Okay, and then certified risk not wrong. Exportation no. Multinational beta no. So this is the correct answer. Okay, this is the correct answer. So now let's move toward the next topic. Next question. The next question is a company that prides means he believes so much in his brand. Right? The company that prides itself on its innovation revised an existing popular brand without conducting sufficient market research. A company that prides itself on its innovation revised its existing popular brand without conducting sufficient market research. By taking this action, the company exposed itself to what type of risk? The company has revised its brand without sufficient market survey. And what type of risks it is involved? It has hazard risk and credit risk. No. Hazard risk no, and credit risk no. Okay, default of credit, there is no default of credit. Hazard is some sort of hazardous risk. Okay, then credit risk is not strategic risk is there, but credit is not operational risk is there, hazard risk. And the D is strategic risk and operational risk. So seeing this thing, we can find that there is some strategic error. Okay, the strategy was not good, so this is correct, and then it is related to operation as well. So I think this is the correct answer. Okay, this is the correct answer. This is correct. Okay, D is correct here. Question number 3. Now, first we are moving toward next question. Next question: the risk that security cannot be sold at reasonable price on a short notice is called. If a security cannot be sold at appropriate price or at market price in a short notice, is called what type of risk? Default risk? No, it's not a default risk. Interest rated risk? It is not a interest rated risk. Purchase power risk? It is not a purchase power risk also. It's a liquidity risk. Okay, liquidity. The security lacks liquidity. Liquidity means when we can convert a security in a very short period of time into cash, then we can say that it has the feature of liquidity. So that risk associated with liquidity it has, because it is not able to solve the security in a short span of time, in a short notice. So this is the correct answer. Okay, let's move toward the fifth question. A German clothing retailer sells its product mainly online. Okay, it sells its product mainly online to the customer worldwide, and all over the world. It's selling online its product or the garment. The company management believes that its primary risk related to the problem with its online website, and the secondary risk is exchange risk. First is related to online website. First related to online website, and the second and the secondary risk is related to exchange risk, or volatility. Which one of the following best describes the company's primary risk and secondary risk? Which one is best describing? Strategic risk, okay, and the finance risk. So here, see here, exchange risk related to finance, and operation of the online website related to operation. So let's see which one is there. Strategic risk, finance risk, hazard risk, operational risk. That online website is related to operation risk, and exchange risk is related to finance. So finance is there, and option is there. Here we are getting the perfect combination. So this is the correct answer. Okay, the correct answer is this, C. Okay, so fifth is also completed. Now the question number 6. When a company is purchasing temporary investment, which one of the following best describe the risk associated with the ability to invest in a short period of time without significant price concession? This question is saying when purchasing temporary investment, which one of the following best describe the risk? Temporary investment related risk. Which one is the risk related to temporary investment? Which one is the risk related to temporary investment, which describes the ability to sell the investment in short period of time without significant price? So someone is liquidity, interest rate, purchase power risk, or financial risk. Yes, here the liquidity related we have already discussed. Short period of time, we are not able to sell the security at the market price in short period of time, then it is a liquidity related. So this is the correct answer. Okay, let's move toward question number 7. A measure that describes the risk of a measure that describes the risk of an investment project relating to other investment in general is a measure which describes the risk of an investment or a project related to other investment or a project is called beta coefficient, standard deviation, expected return, or coefficient variation. That is beta. Risk is called beta. Okay, beta. So this is the correct answer, beta. Okay, beta. We have already discussed in the first question. So this is the correct answer. Okay, now last question. Question number 8. Systematic risk. Systematic risk is what? A risk that can be diversified by holding the security in a diversified portfolio. Second, the risk that can be quantified. The possibility that investment cannot be sold for market value. The risk that cannot be diversified by holding the security in a diversified portfolio. The correct answer is D, because we know that systematic risk is a kind of risk which cannot be diversified. We should remember this term, diversified. We cannot mitigate this risk. Okay, it cannot be diversified. For example, the risk which is faced by every player in the industry, okay, or every company. So, for example, inflation. If there is inflation in the economy, that inflation will be faced by every company, not only a particular company. If there is a natural disaster or a pandemic like currently we are facing corona, due to which there was a huge fluctuation in the security market. The price was getting down. Now even today also, or even now also, when I'm recording the video, you can see that the current market price and the market price of one year back, you can see there is a huge difference just because of this pandemic. Okay, so these are the risks which we cannot diversify. So these are the risks faced by the organization, even if we have a most diversified portfolio. So this is the systematic risk. So thank you. We have discussed all the four one of few important questions of this risk and return.